Hi guys, welcome back to my YouTube channel. Today we're talking all about company structures. We've been running through tax smart, alphabet, freezer shares, family investment companies and much more. It's a fantastic video, tons of detail. I definitely recommend watching this one to the end because you will not be disappointed. But as always, before we kick things off, please make sure you are giving this video a big fat thumbs up and also subscribe with notifications turned on so you do not miss out on the fantastic tax saving videos we post 3 times a week. So first thing, what is a family investment company? So family investment company, often called FIC for short. Family investment company, for all intensive purposes, it's a standard limited company. By this I mean it's going to be registered at Companies House. It's governed by the Companies Act 2006. It's got articles of association, you have to produce accounts, corporation tax returns and everything like that. But there are a few particular distinctions which make family investment companies a bit more attractive from a tax point of view than a standard limited company. So with a family investment company, usually the way they work is that a company is set up, or it could even be a normal existing company, and you've got the older generation and they've basically got cash, assets, something they want to start protecting from inheritance tax, but they also want to invest it at the same time. And you've got the younger generation as well. So the way it would usually work is the older generation, if they've got the company set up, they'd be the existing shareholders of that business. But in this case, when we're running through an example of a brand new limited company, so this older generation, they've basically got £1 million. We've got a cool £1 million of funds that are looking to utilise from an inheritance tax point of view. What they're going to do is they're going to loan this to a brand new, so a new FIC, so a new family investment company which has been set up. And the older generation, they're going to loan £1 million to it. But what's also going to happen is from this company as well, so a new family investment company, the share class is on this. So usually when you set a company up, you'll just have standard shares, ordinary shares, one single class. And if you wanted the older generation, if you had a kind of a family unit, you'd all have ordinary shares, and that would be the end of it. But no, what we're going to be here is we're going to be savvy from a tax point of view. We're going to be smart when we're looking at the company structure. We're going to be tax smart at the end of the day. So we're going to look at better ways of doing this. And one way around this is by having 2 different share classes. We're going to keep it simple for now. So we're going to have A shares, which basically have voting rights. And who's going to own these? The older generation. So they can control the funds, they can control the investment decisions. You could also extend that out, so if you wanted basic dividend rights, if they did need any income from the property business, you could play around with that. But what's actually going to happen is the younger generation, we're going to have the B shares, and they're going to have the capital rights. So capital plus dividends as well if needed. And now what this does is that £1 million loan, that's going to be owed by the company to the older generation, which means that it can be pulled out. So as soon as this company, this new company over here, is generating profits, it's got rental profits, capital gains, you're remortgaging properties, you're pulling out equity essentially, that money over time is going to go down. So that £1 million is going to go down. So that money is going to be pulled out of the company, and basically it's going to be spent, it's going to be enjoyed by the older generation potentially. But what's going to happen to the company is the company is going to go up. So the value of the company is going to go up as property prices increase, as it accumulates rental income, it's got retained earnings. But what's going to happen is all of that increase is going to take place outside of the elder generation's estate, because what would usually happen is they'll own the shares, it'd be exposed in their estate for inheritance tax purposes, where it'd be chargeable at 40% potentially for inheritance tax purposes. It's going to fall outside of that and it's going to go into the younger generation. So it's a fantastic way of the older generation utilising their funds to build up property businesses, any other businesses potentially as well. They're going to be able to retain voting rights, they can control the investment decisions, they can potentially take income from it as well. But the younger generation are going to get that long-term appreciation in terms of the properties going up, be able to draw the rental income. So that £1 million loan is still potentially exposed to inheritance tax. It could be assignable in certain circumstances, or potentially the money could be pulled out and given away as pets, potentially, depending on their other income and the other gifts that they've made essentially in the 7 years before making the pet. So that's one potential structure of a brand new company. But if you've got an already existing company, what options are there in those circumstances? So what we've got at the moment, so we've got an existing company. So we've got an existing company with elderly shareholders. They're now looking at how they can pass this on to the younger generation and save tax in the meantime. So say for instance this company is worth £1 million. What they could do is they can create a second class of shares and reclassify their current shares. So usually it's just all ordinary shares, but what they're doing is now got A shares and B shares. Those B shares, they've got future economic rights. Future economic rights, so dividends, capital growth, and these A shares are frozen. Which means that you're lock in that value of £1 million on those A shares. They cannot go up, essentially. And you can also basically crystallise any dividends in there as well. So over the years that happens, so they're going to do this kind of way, you've got to plan ahead for this kind of tax planning really for it to have the best impact. So they've planned ahead and they've frozen the value of the shares. Now fast forward 10 years, those A shares, remember they don't get any future capital growth, so they can't have gone up in value. And they've also taken dividends. So dividends have decreased the value of the shares. Because it was worth £1 million, they've taken say £500,000, 500k in dividends over a 10-year period. So now that A share holding is worth 500k. But what's happened with the B shares is they've gone up in value, so property prices increased, so the actual value of the property portfolio, everything like that, is actually 2 million. So what's happened is you've transferred close to £2.5 million worth of wealth from being taxed at 40% on an A shareholder over here to the B shareholder, because you've frozen it and you've basically got the growth in the freezer share. So a lot of people talk about this. It's basically these shares. It's not very complicated, by the way. It's relatively straightforward tax planning. It's been around for many, many years. Certainly no one new on the internet has kind of devised these things. I've been working in top 20 firms for a number of years now. We were doing this 5 years ago, end of the day. A and B share planning. So essentially you've got the A shares, their value is frozen at that date. You've got the B shares and they're entitled to the future capital growth of the company and things like that. Obviously you can play around with the voting rights to suit you and to suit the family, but if you wanted to take things further, you can add a trust. So if you've got a trust structure in place, what you'll do is you'll give the shares to the trust. There might be some tax to pay depending on the value, but if it's a new company or even if you've got the B shares, technically they've got a negligible value because you're uncertain as to the future capital value of those shares. It can't be ascertained. Who's to say whether house prices will go up, down, left or right? Certainly not HMRC. So you can put those B shares into a trust. This is going to allow you further control over those shares, so if anybody gets married, things like that, protect those shares, protect the family investment company from unscrupulous ex-partners and things like that. Makes it safe from divorce proceeds because the trustees will hold on to those shares. And also further tax planning as well, inheritance tax planning. You can change the beneficiaries of the trust, which can be fantastic when it comes to passing them on to the next generation potentially. So yeah, just to recap essentially, so what have we gone through so far? So we've looked at some of the inheritance tax planning that is possible, and basically, you know, the loan, so that director's loan for an FIC, points to remember, so the loan, exposed. So that £1 million loan that's going to go in as director's loan, that's exposed to inheritance tax. If they were to die the day after doing this, that £1 million loan is going to go into the estate, potentially be taxed at 40%. The B shares are at nominal value, so they're going to be at nominal value. This means a 7-year rule probably irrelevant because there's not going to be a massive value to them, so it's going to be well within that basically that nil rate band. There's also going to be no restrictions on loan sizes, so the loan can be any amount, so there's no restrictions. And another fantastic basically advantage of the FICs, especially if you've not got a trust involved, there's no entry or exit charges. So family investment companies are a great alternative to trusts. So no entry, exit. And it's important to note that basically all of the assets are under parent control. So this is fantastic where you are looking to pass that wealth down to the next generation. So assets, parent control. And also the dividends, so dividend payments, because they've got the voting rights, that's under parental control as well. So this is what's fantastic about family investment companies, and it's why it's a structure that might be beneficial for your business to pass significant amount of wealth to future generations. And again, you know, if you did want that extra protection, because those shares are owned potentially, the shares are going to be owned by your children individually, they are at risk should people get divorced, should people be bankrupt, things like this, they're potentially at risk. So that's where you can have a trust for further protection. Family investment companies, they can be seen as an alternative to a trust, but also they can work in tandem with a trust as well when it comes to those extra benefits, such as making sure that your assets are truly protected. So these structures really can be fantastic. These can apply for property investment companies. So if you've incorporated your property portfolio and you're looking to plan ahead for inheritance tax now, this kind of planning can definitely be done with those types of limited companies. And they're also fantastic if you've got holding company, group structure, or even a trading business. This type of planning can be massively valuable when it comes to making sure that everything is as tax efficient as possible and making sure that you keep a tight grip over the family wealth, and make sure it only passes to the correct bloodline and that assets aren't at risk should people be bankrupt or divorced. Of course, this is very complicated tax planning. It involves a good mix of accountants, lawyers, tax advisors, and valuation agents, just to make sure that everything is done as properly and professionally as possible, because this is very valuable tax planning. A lot of tax being saved. As a result, HMRC are more likely to challenge it. Early last year, the HMRC did set up a task force basically to investigate family investment companies to see whether they were being aggressively used and abused to save tax. The good news is, at the moment, that task force has been closed down. They didn't find any abuse or any evidence of abuse, that people were using family investment companies to save large amounts of tax. But that could change. HMRC could quite easily put this on their radar again. So obviously you need to make use of this planning whilst it's available. So that's just definitely something to bear in mind. Act fast, inheritance tax is a changing landscape. I really hope you found this video useful. If you'd like to book in a consultation where we can run through this, the links are all in the comments below. I'm going to give you 50% off a property structure business consultation. Massively valuable saving there. I definitely recommend taking advantage of that, where we can run through all of this in a lot more detail and give professionally tailored advice. This kind of stuff, yeah, you can learn about it on YouTube, you can get an idea of how it works, but you certainly do not learn enough to implement this yourself. It's great for ideas and guidance, but it's definitely no substitute for professional advice. I hope you find this video useful. Please make sure you give it a big fat thumbs up and you are subscribed with notifications turned on, because this content really is amazing. We're posting more of this and it's getting longer and better quality each and every week, so you do not want to be missing out.